Good afternoon. Welcome to Phillip Mastermind. My name is Kim and I will be host for your session today. Today we are honored to have Mr. Umar Alhadad sharing his experience on ETFs development both global and Malaysia. Allow me to introduce Mr. Umar. Mr. Umar is the Executive Director and Acting Chief Executive Officer of i-VCAP Management Sdn Bhd, Malaysia's largest ETF equity manager and Sharia ETF issuer. Being part of the Kenangan Group since 2010, Umar has been involved in various capital market-related roles such as strategic planning, risk management, digital transformation, as well as multiple mergers and acquisitions for the group. Prior to Kenangan, Mr. Umar was in the media industry at Sparfax, a WPP group company where he spearheaded the Malaysian outfit. This was preceded by his employment experience for the rollout of digital surveillance system for retail bank branches. Mr. Umar is a graduate of Multimedia University, Malaysia, in Bachelor of Engineering Honours, Electronics, majoring in Telecommunications, and a Certified Financial Planner. He holds a Capital Markets Services Representative License from the Securities Commission Malaysia for Fund Management. Right. Before we start the session today, perhaps Mr. Umar can also show what are the benefits of ETF, right? And why should we have ETF in your investment portfolio?
That's great. Thanks. Thank you, Kim. Good afternoon. It's great to be here in the studio of Phillip Capital, our partners in distribution some of our products in Malaysia. We're honored to have this session today in the good company of Kim as well as his colleagues behind the scenes. That's been very instrumental in getting this session up live. So, I'll get straight into it. Just a bit surface introduction on i-VCAP, the issues of my ETF. The company is called i-VCAP Management Sdn Bhd. Our products are presently branded all as called as my ETF. All of them will have a suffix of my ETF followed by the corresponding index that it manages. Now, it's a wholly owned subsidiary of Kenanga Investors Bhd, which is part of the Kenanga Investment Bank Group, listed entity, listed financial institution on Bursa Malaysia. We have the license for fund management that's been awarded to the company since 2007 under the CMSA Act. And as of 2 months ago, 30th September, i-VCAP is the manages total AUM of close to 320 million out of the 4 ETF it manages. It's looking to, with the vibrant market conditions of ETF being picking up in Malaysia, it's looking to, in the foreseeable future, to be introducing some new products along the near horizon.
Mr. Umar, would you like to explain how's the landscape of ETFs development globally?
Okay, I think globally it is a very, in America, for example, it is a very, very vibrant product. The exchanges. You have products that can be as plain vanilla as the S&P 500, and you have products that can be as exotic as you can think of. It can be to the minor strategy of semiconductor specific for a particular industry. And when you talk about EV also, it can be EV to a specific component of the EV itself. Right, there's many themes of investment products, especially in very mature markets like in the States, where you have more than 1,000 ETFs being listed. We are getting there, Malaysia. But at the moment, on the Malaysian front, I think there's plenty. The market is expanding. Regulators are regularly updating the guidelines and allowing for more exotic products to be introduced. For example, our parent company, Kenanga Investors Bhd, are issuers of the leverage and inverse ETF that's listed on Bursa Malaysia as well. And this is typically a product that's being used for trading strategies for those who are active traders. And with the growth of regulatory development, I think that's when subsequently the market will take shape further, and we can see as for adoption, for example, more and more retail investors are getting involved with ETFs, either on the market or even through fulfillment products that's been made available, simplified by Phillip. So, on our side, as part of our duty, we work closely with the exchange as well as with our peers in the industry as well. We have competitors, but because we are equally growing this market, so we do have joint engagement sessions, education sessions, to create more awareness, as well as hopefully that the market at large would have additional avenue as for investment products that can fit into their overarching investment portfolio. Yeah.
Good to know that the development of ETFs has been very vibrant both globally and Malaysia. But first thing first, for the benefit of the audience today,
Yeah.
would you like to explain what is ETF and how do we use ETF for investment purpose?
Sure. If you can see from the page here, ETF is essentially, it all comes down to a thing that we call collective investment scheme, pool investments. The concept is very much the same like a unit trust, right? The only difference, if I were to give a simple one-liner to explain what an ETF is, for the audiences that are familiar with unit trust and also familiar with shares, ETF essentially is in between. It is a listed unit trust product. It's a listed collective investment scheme, whereas unit trust is typically distributed by various distribution channels. ETF are like shares, where it is accessible to the stock exchange. Like for instance, our products are all listed on Bursa Malaysia. So equally, other ETFs are listed in their corresponding markets in Singapore, in Australia, and Korea, which is one of the vibrant ETF markets in the world, alongside Taiwan. So yeah, it is a listed unit trust. So there's no much complexity between the two. It's very much the same. The only difference is the fees it charges, the way it's being distributed, the access, and most importantly, from the investment point of view, is the manner of it is being managed.
Yeah. And I can see from the slides there are different types of ETFs. We have equity, fixed income. Would you like to explain more about this?
Okay, so whilst your product is listed on the stock exchange, it's typically known as shares, or people commonly refer, the proper name is called being equity. However, the ETFs, whilst it is an equity product, it has various types. If the equity product, if the ETF is tracking an index that is underlying equities, let's say the FBM KLCI, it is an FBM KLCI ETF that tracks the performance of the 30 constituents of the of FBM KLCI. Therefore, that is called an equity ETF. Now, equally, you have something of say fixed income, right? If it is an ETF that tracks all the government debt papers of America, then therefore that the underlying of it that's not seen by the user, that's been managed by the fund manager, consists of bonds, government guarantees, and papers that's issued that's linked to the index. So we can have, let's say, equally in Malaysia, we can have a MGS ETF. Okay, so that's an example of a fixed income. Alternative assets can be, precious materials. Like you have gold ETF, you have silver ETFs. In some markets, some crypto ETFs as well. And leverage and invest, as the name implies, it is an ETF that, for example, our 2 times leverage and invest ETF in Malaysia that tracks the KLCI. So the reference point would be the index, and the performance is based on the 2 times or 1 time invest. And they are also actively managed ETFs. ETFs are typically passively managed. So they pick an index, they track the index, and they copy it exactly as what it's supposed to be. They don't veer off from it. However, now, because of the distribution and the ease of access of ETF on the exchange, some unit trusts are being launched as ETF, which are actively managed. So the constituent change based on the fund manager's view and strategy of that ETF, as opposed to a passive ETF, equity ETF that tracks exactly what the index provider provides to them.
So if you realize that Mr. Umar actually keep on repeating ETF is a benchmark that actually tracks an index. So would you like to explain, is that but technically any kind of index or benchmark can actually be tracked by ETF, is that so?
Yes, correct. Provided that, typically how a product is conceptualized, we work with the index provider, the top index provider that we use Dow Jones, we use MSCI, and we inform them that, okay, we're looking for a particular strategy. Now, for example, what we have as one of our products, the My ETF US 50, what you see on the far right, it replicates the returns and the performance of the top 50 Sharia counters listed in America, on both exchanges, right? So every month, we get informed regularly. The index goes through a rebalancing exercise, which I'll go through in a while. That they tell, okay, these are the 50 stocks that will form the basket of your index, and this is the corresponding weightage. Now you can see on the screen that you can see that 9.9% is Microsoft, followed by Apple, Google, the typical tech products, and you have a car maker there, Tesla at 4%. So the list stretches all the way to 50 counters based on the corresponding weightage. So not all of them will have, let's say, all of them will have a 2% weightage on because we have 50 constituents, but based on that, so we just replicate it and we'll follow the index, and our performance of the fund will follow exactly what the index has.
Okay, so you're saying that ETF actually, in terms of the performance, right, mainly is to mimic the performance of the benchmark itself. So is there any way we can actually minimize the tracking error of that ETF itself?
Yeah, well, the tracking error is not minimized by the user. It is the duty of the fund manager to have as tight as possible of a tracking error that the index tracks. So, for example, right, let's take a step back and see what is the tracking error. The tracking error is basically the divergence of the performance of the product against the index that it tracks, right? Because we're an ETF, we are supposed to mimic it. So the smaller the number, the better it is. As opposed to actively managed fund, the intention is to outperform the index that they have identified. So on that realm, a big tracking error can be a positive thing, or depends how the view of the investor is. Now, tracking error is essentially about variability. The difference is not a negative thing, right? Tracking error, it's not a metric of the fund performance. It's one of the metrics of the fund. Now, there are many things that affect tracking error. Some of them is the total expense ratio that the fund charges. Okay, the smaller it is, the tighter the tracking error will be. Transaction and rebalancing. Now, what you see on the screen is, as an ETF, it's not static. Like you see the basket of the previous slide, that will not be static quarter on quarter. Every quarter, the index provider will inform us that, okay, the index has shifted a bit. Okay, maybe the weightage of Google has been reduced, or maybe there's a constituent that's no longer performing, that does not meet the criteria, will be dropped, and a new entity will be introduced. So the index is very interesting because it's dynamic, but it's not as aggressively on a day-to-day basis, because any multiple rebalancing will affect the cost. So that's why it's only typically done every quarter. And also there's another interesting one that causes tracking error to move is this thing called cash drag. So some of these counters will receive dividends. So the fund will receive dividends. And we will hold on to the dividends and either be reinvested or the dividends will at a later date be distributed. So from that point to that, we are holding cash. So it's not 100% identical to the index, as we have maybe a slight 0.2% of cash holding. So that causes divergence. So the timing as well, the timing of an index change is instantaneous, whereas a rebalancing process can take 2 or 3 days. Depending on the market conditions and the volume,
liquidity, and what
current. Now, also on the positive side, the tracking error can be improved if our shares inside the fund are being loaned out. This is a bit technical. When we loan out our shares because they are static, I wish the returns will be reinvested to the fund, and the holders will enjoy the benefits.
I see. So whatever names that we see maybe 20 years ago may not be relevant now. Is that so?
Yes, that's so true. I mean, I really like this slide, and if you see the ones on your left, the top 10 S&P 500 company. The Standard & Poor's 500 is the most well-known index in the world. It tracks the 500 companies by S&P, and this shifts the constituent shifts so much. I'm using 32 years, as I'll explain you what happens 10 years later from now. So try to have a mental image of the picture on the right. But let's talk about the one on the left. If you can see the one on the left, you have IBM, the beginning of computing, but not really personal computing yet at 1980. And you have a telco, AT&T, telecommunication. But after that, you will see an oil company after an oil company. 1, 2, 3, 4, 5, 6, 7 oil companies, which is the top 10 out of 500 companies in America. And then you have GE.
Yeah.
Okay. Now, shift 32 years later, you look at the S&P 500 of 2012.
Yeah.
Yes,
evolved.
And you see there's Apple there. And I find this quite amazing. If you look at the data from 1980 and even until today, until this the image on the right, you can see Exxon seems to manage to survive in the index. Exxon is the only oil company, and Chevron, excuse me, there's a lot that's still there. The AT&T is still maintaining its top 10 position at 2012. And of course, our vaccine provider Pfizer is there as well. GE has moved up. So you can see that change is constant. The valuation on who makes the cut to the index, to the S&P 500 changes. Whether it changes at the bottom or the top 10 changes. You see the top 5 companies are no longer there. So this ties to the revolution that the globe is going through, whether it's an industrial revolution, it goes to the digital revolution, and all that. So it's not sustainable. Not because they are there, they are bad or poor, but because there are other stronger companies that will make up the index.
So as the world evolves, the component or even the sector that the index is investing may be different, and that will also impact the composition of the ETF itself.
Absolutely. I mean, if you go back to the previous slide, just for a bit, right? There was very cheeky research that was done by this research house called Net Davis from 1972 to 2013. If you were to invest $1 in 1972 in the S&P 5, which is a diversified investment, your returns will be up to close to 5,000. However, if let's say, you know what, I don't want to pay the fees associated to ETF. I'm going to do this myself on my own investment, and I'm just going to invest on the number one company. Every year they change. If this guy's going to be number one, I'm going to sell. I'm going to go into the number one. Keep changing. So he may invest in IBM in 1980, and then but at that point he will just be investing only in Apple. The returns will just be 400%. So the value of diversification is immense because you enjoy the upside, you're covered on the downside. And the upside is the top guys are always being changed.
It seems that ETF has a better diversification benefit compared to owning a couple of top market cap stocks in the portfolio itself.
Yeah, that's right.
So in terms of the top holdings and sector allocation right now for my ETF US 50, we see that actually in terms of sector, it's actually largely exposed to IT sector. So is there any reason why the index itself, the ETF itself is so overweight into IT sector?
Yeah, I think naturally, that's where the market is, and these IT companies, whether it's the NYSE, are really very putting their dominance onto the market. Right? We've seen Amazon's market cap soar. At exponential rate, especially during the pandemic, right? Companies such as Zoom out of nowhere, and the user, it's essentially the change in dynamics of the world. And yet you see, just now the slide that we saw was 2012, and now 11 years later, we see Exxon is still surviving. So whilst there is concentration on IT in the top 10, you can see that there are other industries there still. So your exposure to such markets is not, it's heavy on IT, but there are others that may complement when some counters are getting butchered, some industries are getting affected to market conditions. There will be others to influence it. So when you have 500 constituents, the shifts are very well balanced.
Correct.
So we've opted with 50 instead. because we felt that this 50 would be sufficient.
For diversification.
For diversification purposes.
So apart from diversification, is there any other benefits for ETF?
Well, that's a good point. We got instant gratification in Sing here. It's highly regulated. It is a regulated product. So it is regulated product. It is on the exchange. So let's put it this way: the governance when you have a product on the exchange is as strict, if not stricter, as how a listed company. We have many listed companies here, and they are required to meet very high standards of disclosure requirements to their shareholders. They're being monitored by shareholder groups. So equally, an ETF is regulated in that sense. And so we have Bursa Malaysia, they have their regulatory arm. We have the Securities Commission that manages everything with that involves the collective investment scheme, and with the utmost importance, emphasizing utmost importance for investor protection. So we are operating in a very well regulated NSA space. Another benefit of it is global access, right? So we can provide access to markets through ETFs, like our MyETF US 50, immediate access to the top 50 counters. You don't have to pick and buy all 50. It's all bundled in one. You pay one transaction cost, and the same goes for an ASEAN product, or even you have a China focused product as well. So the ETF is passively managed, so we take out all the emotions from anyone in the office on our side, and it is the index comes this quarter, MSCI, Dow Jones will tell us, right, this is the new constituent.
What's the composition?
Change it. So we change it.
So it seems that as long as we can actually, utilize ETF for diversification purpose, we can actually enjoy a good return over the long term.
Yeah, hopefully. I mean, it has been shown. It has been shown. You see on the chart here, the S&P 500 index, right? Which our MyETF US 50 has been outperforming. On a 10-year return, the annualized return is 10%. And the beauty of this is, because the product itself has taken all elements of active management and purely taking out all the emotions involved and just make it a passively managed product. It is also recommended for the investors to do the same. Right. So we can never, if there's anyone today who say that they can time the market, maybe the richest man alive, I want to be his best friend. So you can see market goes through cycles. We've dropped so much during COVID, February 20. You can see it's a big dip. And if you look at that February 20, and it took them only a year for it to recover back. And when it recovers, it will recover to newer heights. Okay, and then year 2022 has been a soft year for the American market, and now it is recovering back to so you can see that at every dip the recovery rate has always been better. So therefore, we don't time the market. I like this saying. When we're learning our financial planning, back then they said, you pay yourself first. So you get your salary, you get your income, you invest in yourself first before you pay all those other bills that you have. So this is a good practice when they especially for this kind of product. The salary account is on the 1st, on the 25th, on the 7th. Invest in the product and look at it.
Speaking about that, when we get our salary, for example, we get our salary every end month, right? So in order to, because you also mentioned that investors shouldn't time the market, is there any way we can actually ride through the various market performance through perhaps maybe dollar cost averaging? Is there a good way to manage our investment?
There's a very, very good way, because you don't know. We do not have foresights. There are always predictions. There are research reports out there. Some hits, some misses as well. So that method of investing regularly, dollar cost average. A lot of people who want to, oftentimes people are trying to chase the market on the uptrend. All investment is going up. When it is going up, you might be buying it at a higher price. And then next month or 3 months down the road, you're going to sell a lower price. I'm accumulating all this money, waiting for the right time. And you don't know for sure it's the right time or not. So when you keep buying it regularly, it averages out your costs. It averages out your entry points, your Even, we can show some slides later about how it enhances your return as well on an actual product.
Yeah, it's a disciplined manner, I would say.
It is a disciplined manner, just like how you treat your credit card bills being, you don't want to get charged your 15% interest rate. You should treat investments such as this as a regular and constant thing.
In fact, just now you also mentioned that we have an example illustrating the benefits of using DCA in terms of ETF investment. Would you like to elaborate more on that?
Yeah. So I think this is a great slide to exemplify the effect of dollar cost averaging. So we have two profile of investor A, investor B, with the colors that's been affixed to that. Now, investor A invests every 3 months. Maybe that's the time it needs to accumulate. If you ask me, a shorter interval is always better. If they do it 1 month,
even better.
It's even better. You are safeguarding yourself against the price as well. So now they both invest in total 100,000. Now 5,000 invest every quarter for investor A, it adds up to 20,000, which matches investors B's capital for the next 5 years. Right. So same duration, same horizon, 5 years as well. Okay. Now you can see that based on this product performance with the blue dots, those were the entry points of where the investor A came in. And there are times that investor B may have entered it at a lower price, like the second last diamond marker there as well. But waiting for that, the money is not working. The money is idle. The money is not being put to work. By putting it more regularly, is regularly working. Your money is out there doing what it's supposed to do its job. You've done your job in earning those, and now it's time for the money to do its job in earning you the returns suited to your investment profile. So now you can see that the effect, we've done a calculation based on this My ETF US50, one of our products, that the average price, you can see that is $6.70 against $7.50. $7.50 against investor B. Okay, so fine, there's just one number to look at. Okay, this guy buys it more, this guy buys it, investor A buys it cheaper. But if we look at the returns, now a 10% returns in terms of difference between the two.
It means something.
It means a lot. So you can see from the graph, the total end value that is a split of 10,000 ringgit for the same exact amount. So for 100,000 investment, investor A had gained 10,000 more compared to investor B. So yes, maybe you like 40% returns, total net returns. But if you compare it,
correct.
I think 50 is better than 40.
Yeah, definitely. So we can see that actually in the beginning of presentation, we have covered ETF, the development in global as well as in Malaysia. Then we also talk about what is ETF and the benefits of ETF, including is a highly regulated product and also help investors with diversification. So for an ordinary investor like us, how can we actually invest into the ETF, and where can we buy the ETFs itself?
Okay. Well, again, the ETF is a listed product on the stock exchange. Those with a CDS account are comfortable managing their investments on the stock exchange, can do so on the stock exchange. They look up my ETF, they look up any ETF for that matter on Bursa Malaysia, and they can buy just like they buy any shares. Also, we have people in the market who are not comfortable dealing on the exchange, who may not have a CDS account. So even if they have a CDS account, they are not familiar with placing an order, putting in settlements. So I think we're blessed in the sense that Phillip Capital has provided ease of access to this product. Phillip has got the PMA and PMAT. I think we can run through it a bit later, and which allows paid investors using their cash, or if they have sufficient funds in their account, ETF account once, they can have access to my ETF series, because I think Phillip has got a specific it has a portfolio with an ETF strategy that's managed by the fund manager. So there is ease in terms of someone assisting you to transact, and also in terms of managing the portfolio, because you can buy the one You can choose to buy a few, and then the Phillip Fund Manager will work this way.
So there are actually different ways where investors can get exposed to ETFs investing. So would you like to explain, like under my ETF series by i-VCAP, apart from those, just now we also mentioned that they are global-based products like those that we invest in US. We also have. Do we also have products in Malaysia as well?
Yeah. So we do have that, like exactly what Kim said. We have the ETF. We have access to global markets. Now, so how we do it? We have this investable universe. Okay, we apply Sharia filtration. It's very important that we have this Sharia filtration, which is applicable to a lot of scenarios. It's open to all, right? And then we channel it to by country. We are the team by country, and also by factor base. So for example, for country, we have an ETF that tracks the top 25 Sharia counters in Malaysia.
Yeah.
Also, as per previous examples, we have the top 50 counters that also deemed as Sharia by the Sharia bodies in respective market, as well as verified by the local Sharia authorities and Sharia advisors.
SIC,
SIC, as well as our own Sharia advisors as well. That's on market broad base. We also have a dividend yield base where it is companies, they are Sharia companies that issues dividends in Malaysia. Also, we have one that is ASEAN based. It's dividend, but focusing only in the ASEAN region.
So what is interesting here is that the ETFs that we see on the screen here, my ETF Dow Jones Islamic Market, Malaysia Titans 25, the Dow Jones US Titans 50, my ETF MSCI Malaysia Islamic Dividend, as well as the Southeast Asia Islamic Dividend, they are all Sharia compliance products.
They are all Sharia compliance products. So this helps, we have, if you have an EPF investor that has a Sharia account, they would be able to access this product through PMAT ETF.
So would you like to elaborate more on these 4 ETFs under the My ETF series?
Okay, so the first one, we have the US 50, just because that's the one we've been talking about earlier as well. It tracks the 50 largest Sharia compliant stocks in the US. Gives you access, whether through Bursa or whether through Phillip, to this to all 50 counters that make up the constituent of this ETF. It's US dollar based, and I think the returns are pretty stellar. We like this product. Now I think we can touch a bit in terms of risk. Right? I think BYB, right? The product is quoted in US dollars. And there is every single product will carry risk. I think we need to be mindful of the risk associated with the product. So the added risk for this product which is not necessarily negative, is the currency, because it's US dollar denominated. Now we've run some numbers. The US dollar has appreciated to about 14% compared to the ringgit. So naturally, if it can go the other way as well, but someone investing in this for the past 5 years would have added that additional 14% gains. For the
currency gains for
which is not, this is what you see on your screen right now is just purely the US dollar gains. Right, the NAV of the fund, which is in US dollars, without factoring any currency.
I see. So apart from my ETF US 50, we also have another Malaysian version of ETF itself. Would you like to elaborate more?
So this is a broad, again, this both like the US 50 is a broad-based market ETF. You can see very familiar names there, the 25 top Sharia counters in Malaysia. You have IHH, which owns some of the major hospitals here. Petchem is there as well. Press Metal, the darling of our smelting business. And the Merchco, Celcom VG is there, Telco. So these are familiar brands, and these are very, very strong companies. They are listed on the exchange today. You can see the top 10 of this company make up 67% of the constituents. So the balance, the remaining 15, will make up the remaining, 23%? 23%, excuse me.
But the performance year to date and even since inception has been lackluster. So is there any reason for that?
Well, I think it is what it is. The index performance of the Malaysian index for the past decade has been relatively not ideal. So then is it a long-term thing? We hope that with the shift of things, and we've seen the numbers improving. right? I think you can see that there are improvements to the numbers, and yeah, this could form part of your portfolio if you have you still would like to have a
Malaysia exposure.
and ringgit exposure.
Yeah. The next one is this is a Southeast Asia product, right?
Yeah.
Okay, so we actually get exposed to different countries like Malaysia, Thailand, Indonesia, Singapore, and Philippines. And the names that we see here, are they all also some of the large cap companies in their respective countries?
Yes, large cap companies with added filtration, like the 1040 index, and with high dividend yield. So the index provider has got very strict parameters, and you can see the country allocation. We still heavily in Malaysia at 45%, followed by Thailand and Indonesia. If you look at the constituents as well, PTT Explore and Petchem, these are two, the top three companies are the oil and gas companies here. And you also have companies such as Unilever, FMCG companies. Equally, IOI and Samdabi is there as well. So these are familiar names, and you have a broader access to ASEAN. And it's not just specific for Malaysia. So if you feel that the Malaysian dividend play is not something that you're keen on, and you want to say, you know what, I want to have a greater diversification to this region, I'm just going to get this product and see how it does it fare. It's one of the better ones. Yeah, we've seen, the 3-year performance at 21% is commendable for passively managed product.
So it seems that for investors and ordinary investors like us, when we don't have access to market, for example, access to ASEAN market, we are not familiar with what the listed companies based in, say, Thailand, Indonesia. It's always good to have exposure into these countries, into these markets by using ETF.
Yes, it is an avenue to ease access.
Yep. And the final one is Malaysia Islamic Dividend. Think pretty similar. It's also a Malaysia-based product, right? We can see like even PCAM is one of the top holdings in the ETF itself, right? So would you like to elaborate more on for this product, whether it's suitable for what kind of investors?
Yeah. So I mean, these are meant for investors who want to have a dividend play in their portfolio, and who do not want to be picking, to be involved in a stock picking, or to have a concentration of just one or two. So you have very strong names in there. You got Nestle. Even though at 4.8%, that constitutes 20% of 25%, 20% of the index. Their position at Nestle. And again, the press metal of Petchem is there as well. So you are averaging out, because if you don't know, I mean, whilst these companies may have dividend policies, there are hit and misses for certain years as well. So if you believe strongly in the dividend play and you would like to diversify your dividend exposure, this is an avenue for specifically for Malaysian market.
So we have covered opportunities in ETF investment. Apart from the risk that you mentioned just now, which is the currency risk, is there any other risk when it comes to ETF investment?
Well, there were like any product, right? It is very important to know buyer beware before going into any. There are market risk, there's currency risk, and there's execution risk at the buying side. You can get it off by going to Phillip, and there's also the manager's risk. Us being one of the largest, being the largest equity ETF manager, so you can put some weightage to our risk as a manager on that front. But have we been performing? We have a limit of, for example, 3% tracking 3-year tracking error. We are operating at our highest is about 30.3% in terms of tracking error. So in terms of manager risk, I think on that front, coming from a reputable group in Penang, being able to maintain the tracking error with strict controls and policies, so that is some risk that you can put aside. Now, market risk, sectoral risk, industry risk, we can see during COVID, what has happened? The construction industry couldn't move, some of the assembly lines couldn't move, cars were not being shipped, the retail thing was risk. So was that there's risk? Not all risks are bad. So how that's where the power of diversification comes into play. So whilst one industry is getting hammered, the others could be confident in it as well. So
So the keyword is still diversification.
That helps a lot with the whole risk management process.
What about the fees in ETF investment? I think you have a slide in the beginning that mentioned investing in ETF actually charge lower fee compared to actively managed funds.
Yes, that's true. The fees of an ETF are typically lesser compared to purely because it is a passively managed product that we are replicating. That you are the one deciding that, okay, I want this strategy and therefore this is the product for it, as opposed to an actively managed fund. So that is being managed by a manager. You know, there are instances where that may suit your profile, that you don't mind paying the extra fees because you want outperformance. You're taking the additional risk because you want the outperformance of the index, the benchmark that it uses. So yes, active funds do appeal to investors seeking potential upside of outperformance. You know, and ETF can be appealing to those looking for things that are a bit more cost effective. They are more sensitive to cost and with wider diversification options. One good example of why you know, we can do a S&P 500 ETF with 500 constituents. Because we're replicating.
Correct.
You know, but we can't make to get a fund manager with an ideal portfolio for an active fund is between 30 to 50 stocks. You know, you can't make a manager manage 500 constituents.
It's very difficult.
It's very difficult to execute and to maintain.
So we have also covered the opportunities and the risks of ETF investment and the fees as well. How can investors actually get exposed to ETF investment, and what should investors do before investing into ETF? Maybe they have to do some research. They have to maybe engage with some of the. Would you like to elaborate more on that?
Yeah, I think it is, before we talk about how and what they need to be mindful of, I think it's very important for every investor to know what their goals are. You know, what the investment goals are, what is the investment horizon, what is the risk assessment. I mean, we have our suitability assessment that's typically done by all investors through all distribution channels. So once they've determined what their investment goals are, and then there comes the part of product selection. So, for example, if the goal is for the investor's got a longer horizon, whether it's 5 years or more, and it's meant for retirement, and they want something that's more safe. You know, an ETF, a fixed income ETF, maybe something that's suitable. You know, because bonds and all that are not easily accessible to retail, so they can buy a fixed income ETF to have that kind of experience. So what? But if the investor fits in a profile where it can take a bit more risk, and a longer horizon, you know, and equity ETF can be useful as well. Right? So they want greater returns. They're still in the 20s, 30s, even 40s. They do have that runway. They do have the runway to keep putting in more investments for dollar cost averaging. So they can do so as well. So that's the behavioral part of it and the situational. But once you've identified, you are mindful of where you are at and where you want to be, and then you have shortlisted. Okay, ETF is the product for me. Now it's very important to understand the like you said, you know, the risk, the product, the investment objective, the historical performance, which is not an indicative of future performance. Disclaimer that. And you know, you look at the number of the style, the historical trend, and who the index provider is, and who the manager is. You know, are they managing the product well? But in essence, this may not just be the only investment that you have in your portfolio. So you may have a portfolio of maybe, okay, I'm willing to take a long-term view. I want my portfolio to have at least 40% in ETFs and 60% in actively managed funds, you know, by our fund managers locally. And that number may shift. So you know, for this year it may shift to that, and whether it's going to be similar weighted, or does it shift more towards ETF eventually. So it comes down to that. But in terms of product, yes, product risk, market risk, currency risk. Understand, look at the manager, look at the performance, and see how you can get your product fulfilled and how you can regularly get it reported to you.
So on the balance of risk and reward, ETF is also one of a consideration that investors could possibly, you know, consider when it comes to investment. So if we look at the performance here, my ETF US 50 year to date, they have done 33%, 1 year 22%, 3 year 34%. The one that invests into Dow Jones IM25 also registered some returns here, right? There are actually 4 ETFs that is actually distributed by i-VCAP itself.
Yeah.
And would you like to comment on the this slide whereby we see the my ETF performance is actually doing quite okay this year? Is there any reason why?
Yeah, I mean, I think when the product was incepted, the index selection was very, very key. So with all the back testing that was done before selecting just top 50, because we could have gone with 100,
Yeah.
or we could have just gone with 50. So if we felt that 50 would be sufficient to carry the performance, and we don't have to go the full, because putting at 500 would just be going head to head with S&P 5. So we just went with 50 and filtered against Sharia, and with the backtested results, and the index came about to select. Now, was it a good year this year? Yes, generally America, it's been a pleasant year. Last year it was fluctuating as well. Last year it was a dip. Right, so we're recovering, hopefully to new greater heights as it recovers. So you can see, but in general, with a 93% return over 5 years. So it is something that
that is commendable.
We're happy with. And also, we've compared ourselves with some of the local funds that are available in Malaysia, and these are all actively managed. And yes, there are times, in certain markets where passive can be a better bet against active. But in especially in very highly efficient markets like in America. In Malaysia, sometimes you can see that the actively managed funds are always, I mean, if you can see from the previous slide, our performance, if you're comparing some of the active funds with Malaysian strategies, they are outperforming us. So so I suppose in that sense we have that edge, being a passive manager with a broad market view on the American constituents.
So it can also help to navigate along some market turbulence, right?
Yeah, so I mean, we have, I think it's very important that we are mindful that investment comes with risk. Market goes through cycles. We are very much market driven for this product in particular. And and who do we compare with? Okay, so how do we rank ourselves? I mean, we're going to rank ourselves with the de facto S&P 500 index, which has been the most reference product that for the past 40 years, giving you, like the earlier slide, right? For the past 40 years, giving you 10% return. We thought that by using just 50 and with putting in the Sharia layer to allow greater access, we have been successful. I mean, the product has been successful to navigate through these turbulent times and also outperform. If you want to compare it with the S&P 500.
In order to be qualified for this campaign, first and foremost, investors can either choose the cash option, which is PMA ETF, or option 2, which is the EPF option by using PMA ETF. So for option 1, which is PMA ETF, it's open for all investors with cash ready, while for the second option, it's open for all EPF members who has adequate savings in their accounts, right? In terms of the transaction form, there are 2 ways that investors can get exposed to the ETF, My ETF series investment. The first one is the investor itself can either choose 100% on one of the 4 ETFs that is distributed by i-VCAP. For example, in this scenario, the investors, because of his or her optimistic outlook to the US market, My ETF Dow Jones US Titans 50 is a consideration for this investor, and hence he inserted 100% weightage for this particular ETF, right? And then the other way is that the investors can have a combination of any My ETF series, right? Whether it's a US Titan 50, Islamic Malaysian Market Titans 25, Malaysia Islamic Division, or the Southeast Asia Islamic, based on the client's desired allocation, desired weightage, maybe 25% each. This can also be one of the possibilities. So investors, as we mentioned earlier, can either choose PMAT, right, or PMA for these ETF investments. And after all, the most important part is to complete the form with signature entity.